Hey everyone, welcome back. Today, we're diving into what I like to call the ultimate truth teller of the accounting world. If you've ever, stared at a company's financial reports and just felt like you weren't quite getting the whole story, well, you are definitely in the right place. In today's explainer, we are completely breaking down the cash flow statement. We're going to cut through all that noise and show you exactly how to see the reality behind those flashy top-line profit numbers.
So think about this for a second. Why on earth can a highly profitable company still face massive cash shortages? I mean, we all naturally kind of assume that a profitable business is automatically a cash-rich business, right? But the crazy reality is, a company can be wildly profitable on paper and literally still go bankrupt just because they ran out of actual physical money to pay their bills. So how does that even happen?
To figure that out, we've mapped out a clear, logical journey for you today. First, we'll look at the reality behind profit numbers. Second, the three categories of cash flow. Third, understanding the indirect method. Fourth, interpreting cash flow patterns. And finally, 5 conclusion and common mistakes.
Okay, let's jump right into section 1, the reality behind profit numbers and breaking the accrual illusion. As we know, under accrual accounting, landing a massive credit sale immediately spikes your profit on paper. It looks amazing. But if that invoice is just sitting there unpaid, well, your bank account simply doesn't care about your paper profit. The cash flow statement is absolutely crucial because it strips away that whole timing illusion. It separates the promises from the actual physical dollars moving in and out of the bank.
And that brings us perfectly to section 2, the 3 categories of cash flow. We're going to systematically take apart the anatomy of a company's money movement.
You see, every single transaction a business makes can be neatly dropped into one of 3 distinct buckets: operating, investing, and financing activities. It's a brilliant framework because it doesn't just tell you how much cash a company has, it tells you exactly where it came from and exactly where it went.
Let's start with the absolute engine of the entire operation: operating activities. This is the day-to-day lifeblood. It includes cash you actually received from customers and the cash you paid out for core stuff: suppliers, salaries, rent, taxes, the whole shebang. When you have a positive cash flow here, that's a fantastic sign. It literally means the core business is working and generating real money. If it's consistently negative, well, that means the primary business model just isn't self-sustaining yet.
Moving beyond the day-to-day, we have investing activities. This tracks the cash used for long-term assets. Think machinery, buildings, land, vehicles. Now, a super common mistake is seeing a negative number here and instantly panicking, thinking it's a bad thing. But objectively, a negative cash flow in investing often just means the company is future-proofing itself. They are proactively spending cash right now to buy equipment or expand facilities to grow their capacity down the road.
Then we have our third bucket, financing activities. Think of this as fuel coming from the outside. This section shows us how the company is interacting with lenders and shareholders. If they take out a new bank loan or issue shares, cash flows in. That's a positive number. But if they're paying back those loans or handing out dividends to shareholders, cash flows out, making it negative. It's the ultimate tracker for how a business is funding itself when its daily operations just aren't enough.
All right, slow down for a second, because we are hitting the climax of this explainer. Section 3, understanding the indirect method. This is where we actually translate that paper profit we talked about into real, tangible cash.
To calculate operating cash flow, the indirect method uses a really logical 3-step translation process. Step 1, you literally just start with the net profit from the income statement. Step 2, you add back non-cash items, things like depreciation, because hey, no actual cash ever left the building for that expense. And Step 3, you adjust for changes in working capital.
Let's think about those working capital adjustments for a second, specifically inventory. If a company's inventory goes up over the year, what does that actually mean? Well, it means they bought more stuff, and buying stuff takes cash. Therefore, an increase in inventory means we have to subtract that amount from our profit to find our true cash balance. But conversely, look at accounts payable, the money we owe our suppliers. If accounts payable goes up, that means we haven't paid our bills yet. We kept our cash. So an increase in accounts payable is actually added back to our cash total. It's all about following the physical dollars, not the accounting promises.
Let's zoom out a bit for section 4, interpreting cash flow patterns. Now that we understand the 3 buckets, we can essentially diagnose the health of a business just by looking at how they interact.
When you're diagnosing a company, the pattern of these signs tells an incredibly powerful story. Take a company with positive operating cash, negative investing cash, and negative financing cash, a plus, minus, minus. This is your classic mature cash cow. Their operations generate tons of money, which they use to invest in new assets and pay down their debt. It's great. But consider the inverse: negative operating, positive investing, positive financing, a minus plus plus. No way around it. That is a massive red flag. Their operations are bleeding money, and the only way they are staying alive is by selling off their assets and begging the bank for more loans.
Which brings us right into our final section: conclusion and common mistakes. Let's pull all of this together and make sure you avoid the analytical traps that catch so many people off guard.
Here are the absolute key takeaways. First, never, ever assume net profit equals cash in the bank. I think we've thoroughly busted that myth today. Second, don't just look at the single ending cash balance. A company could have $1 million extra sitting in the bank on December 31st, but if that million came from a desperate last-minute bank loan instead of actual customer sales, yeah, that company is in deep trouble. Context across all three of those activities is strictly required.
So I'll leave you with this. Will you ever look at a company's profit number the exact same way again? I really hope this explainer has empowered you to look right past those paper profits and dig for the true cash reality. Remember, the cash flow statement is your ultimate map to finding out how healthy a business truly is. Thank you so much for joining me on this deep dive, and as always, keep asking the right questions.